Picture the Las Vegas Strip on a Saturday night. The neon lights still blaze, the casinos still pump out music, and the fountains still dance with perfection. On the surface, everything looks eternal. But behind the glow of the Strip, a shockwave has just rattled one of its biggest giants. Caesars Entertainment, the empire behind iconic resorts like Caesars Palace, Flamingo, Harrah's, and Horseshoe, has just been kicked out of the S&P 500. This isn't just a financial headline. It's a seismic warning. Because when a company that built much of the Strip's legend can no longer hold a place among America's top 500 corporations, it raises a chilling question. If Caesars is falling, what does that mean for Las Vegas itself? In this episode, we're going to uncover the story behind Caesars' removal, what it says about the city's future, and why this moment could mark the beginning of a new and much darker chapter for Las Vegas. One Caesars and the S&P 500, why this removal matters. To understand why this is such a blow, we need to talk about what the S&P 500 really represents. It's not just a list. It's America's VIP club of business, the 500 largest, most stable, and most influential companies in the country. Being on this index gives a company prestige, credibility, and visibility to investors around the world. On the 22nd of September 2025, Caesars Entertainment lost its place in that club. For Wall Street, the message was clear. Caesars is no longer strong enough in terms of market value, growth, or profitability to stand shoulder to shoulder with the nation's corporate elite. And here's why it matters even more. Many index funds and retirement portfolios automatically hold S&P 500 stocks. When a company drops off the list, those funds are forced to sell their shares. That creates an immediate downward pressure on the stock price, a kind of domino effect that makes it even harder for the company to raise money, borrow for new projects, or attract new investors. Now, combine that with Caesars' massive debt load of $12.3 billion. Losing their place in the S&P 500 isn't just embarrassing, it directly threatens their ability to survive the next few years without drastic changes. 2. Falling revenues and occupancy rates. The numbers don't lie, Caesars is bleeding. In the second quarter of 2025, revenues from their Las Vegas operations fell 3.7% compared to last year. At first glance, that might not sound catastrophic, but for a company this massive, it translates into tens of millions of dollars in lost income. And it doesn't stop there. Caesars is also selling fewer rooms. Occupancy dropped by about 2 percentage points. That may seem small, but in the hotel industry, every fraction matters. Across Caesars' vast empire of rooms, it meant about 27,000 fewer room nights sold in just one quarter. Imagine entire towers of hotel rooms, sitting dark, generating zero income not just from lodging, but also from dining, shows, and gambling those guests would have brought. For a company whose business model relies on the steady flow of tourists filling every corner of its properties, these declines are more than red flags, they're alarms. The Strip thrives on the illusion of non-stop demand. Empty rooms shatter that illusion and reveal a deeper truth. Las Vegas is struggling to attract and keep visitors at the same pace it once did. And while Caesars' numbers are among the worst, they're not alone. The question now is whether this is a Caesars problem or a Vegas problem that threatens the entire city's economy. 3 hidden fees, and the value problem in Las Vegas. For decades, Las Vegas built its reputation on being the ultimate value destination: cheap rooms, affordable buffets, and endless entertainment. The idea was simple: keep prices low so visitors would spend big at the tables, shows, and bars. But today, that image is shattered. Caesars, like many Strip operators, has leaned heavily on hidden fees. Resort fees that once hovered under $30 a night are now regularly above $50 per night, even at properties marketed as budget-friendly, like the Flamingo, Harrah's, and Horseshoe. That means a guest who books a $100 room could easily pay 50% more once fees are added. Then come the parking charges, food and beverage markups, and dynamic pricing that can make a simple weekend stay cost more than luxury hotels in other major cities. Visitors increasingly feel nickel and dimed at every turn. What used to be the land of $4.99 prime rib buffets is now the land of $25 cocktails and $60 resort fees. And guests are noticing. Many say the Strip no longer delivers the sense of value that made it unique. Instead of stretching their budgets in Vegas, travelers are cutting trips short, visiting less often, or avoiding the city altogether. This is the heart of Caesar's problem, and Vegas's problem too. When people feel they're not getting fair value, they stop coming, and no amount of flashing neon can cover that up. 4. Why tourists are turning away. The decline of visitor numbers. The Strip depends on one thing above all else: a steady flood of tourists. But in 2025, that flood has started to dry up. Visitor numbers have been falling steadily throughout the year, with June showing an alarming 11% drop compared to the previous summer. That kind of decline doesn't happen by accident. It's the result of several forces colliding at once. For starters, the US economy has slowed. Consumer confidence is weaker. Inflation is still biting into household budgets, and discretionary spending, the kind of money people use for vacations, is shrinking. For Vegas, that's devastating. Second, the California effect. The Golden State has always been Las Vegas's biggest feeder market. But as Californians face higher costs at home, from rent to gas to groceries, fewer are making the drive or flight to Nevada for a weekend getaway. The Strip feels emptier without them. Third, the loss of international visitors. Canadian travelers, in particular, have dropped sharply. Add to that fewer Europeans and Asian tourists, and you start to see why entire blocks of hotel rooms at Caesars are sitting dark. And finally, competition. Regional casinos across the US and the explosion of online gambling apps mean people who used to plan a yearly Vegas trip can now gamble closer to home or from their couch. For decades, Vegas sold itself as a unique, once-in-a-lifetime experience. But if visitors believe they can get the same thrills elsewhere, at a lower cost, why should they come back? 5. The weight of debt. $12.3 billion hanging over Caesars. Behind every flashing sign and marble lobby, Caesars carries a shadow that few visitors see. $12.3 billion in debt. That number is staggering, and it changes everything about how the company can operate. When a corporation has that kind of burden, every financial stumble becomes magnified. A 3.7% revenue drop isn't just a dip, it's tens of millions less available to service debt payments. A 2% occupancy decline isn't just empty rooms, it's a direct threat to the company's ability to cover its interest obligations. Caesars has tried to ease the pressure by selling assets. They've offloaded the World Series of Poker and the Link Promenade, hoping to raise quick cash. But those sales are like putting bandages on a wound that keeps bleeding. They provide short-term relief, yet they don't solve the structural problem. Caesars owes more than it can comfortably manage in a market that's no longer growing. Debt also limits flexibility. Want to renovate rooms? Launch a new attraction? Expand to another market? Those require capital, and with credit ratings slipping and stock prices down more than 50% over 2 years, raising money becomes harder and more expensive. For a company built on the idea of bigger, flashier, more extravagant, debt is now the cage that holds Caesars back. And when a giant like Caesars is trapped, the whole Strip begins to feel smaller. 6. Competition. Regional casinos and online gambling eating Vegas alive. Once upon a time, Las Vegas was the only show in town. If you wanted the lights, the glamour, the blackjack tables, and the all-night party, you had to come to the desert. But that monopoly is gone, and Caesars is paying the price. Across the United States, regional casinos have exploded. From tribal casinos in California to sprawling resorts in states like Oklahoma, Florida, and Pennsylvania, millions of gamblers no longer need to make the pilgrimage to Vegas. They can drive a few hours and get nearly the same experience without the resort fees, without the overpriced flights, and without the endless nickel and diming. And then there's the digital revolution. Online gambling and sports betting apps have changed the game entirely. With a smartphone, players can bet on NFL games, spin digital slot machines, or play poker from their couch. For younger generations especially, Vegas feels less essential when the casino is already in their pocket. This shift in competition is brutal for Caesars. It means the company isn't just fighting to attract tourists away from other resorts on the Strip, it's fighting to keep people from staying home altogether. Vegas once thrived on being irreplaceable. Today it's replaceable, and often less convenient than the alternatives. And that's a problem no marketing campaign can easily fix. 7. the locals factor, why residents finally matter again. For years, the Strip has treated locals like an afterthought. Las Vegas residents were seen as background characters in a story written for tourists. Locals didn't fill the rooms, they didn't drive the mega resort profits, and they certainly weren't the focus of Caesars marketing. But in 2025, that's changing. With visitor numbers falling and occupancy dropping, Caesars has been forced to look inward to the very community they once ignored. Might have to. This shift is striking because it signals a desperation move. Casinos built their empires on out-of-towners who came to spend freely, chasing the dream of hitting it big. Locals, by contrast, are savvier, more price-sensitive, and less likely to accept sky-high fees. Catering to them requires a different mindset, one that values loyalty over one-time splurges. For Caesars, embracing locals could be both a lifeline and a warning. On one hand, locals represent steady, year-round business. On the other, the fact that the Strip must now court its own residents highlights just how fragile the tourism pipeline has become. Vegas once lived by the mantra, "What happens here, stays here." But if Caesars wants to survive, it may need to flip that line and start asking, what's happening here for the people who actually live here? 8. The quick fix. Caesars promotions and the fabulous 5-day sale. When a company faces pressure from every angle, declining revenue, falling occupancy, soaring debt, it often turns to short-term solutions. For Caesars, that meant rolling out a wave of discounts and promotional events designed to lure back both tourists and locals. The most visible effort was the fabulous 5-day sale. This citywide event promised limited-time deals on hotels, dining, entertainment, and attractions. Caesars joined the campaign aggressively, slashing prices on rooms and offering dining credits for guests who booked early or extended their stays. On paper, it looked like a revival, a reminder of the old Vegas where deals and bargains were part of the magic. And in the short run, it worked. Caesars saw a temporary bump in bookings, and social media lit up with travelers showing off the discounts they scored. For a moment, the Strip felt alive again. But here's the problem. Sales like this can't disguise the deeper cracks. Once the 5 days are over, the fees creep back in, the prices rise again, and visitors are reminded why they left in the first place. Unless promotions become consistent, long-term strategies rather than quick fixes, they risk being nothing more than band-aids on a wound that needs surgery. Caesars' gamble on discounts reveals the bigger truth. The company is trying to buy time. The real question is whether time is enough to rebuild trust and value in a city that many feel has already priced itself out of reach. 9. The future outlook. Can Caesars survive beyond 2025? Caesars' leadership insists that the storm will pass. They point to a strong group calendar for late 2025 and 2026 big conventions, trade shows, and sporting events scheduled to bring thousands of visitors back to the Strip. In theory, these large-scale gatherings could stabilize occupancy and revenues, giving Caesars the breathing room it desperately needs. But optimism has limits. Wall Street isn't convinced. With the stock down 30% this year and more than 50% in 2 years, investors see a company under siege, not a company in recovery. The removal from the S&P 500 wasn't just symbolic, it was confirmation that Caesars is no longer viewed as a leader in corporate America. For visitors, the issue is even simpler: value. As long as resort fees hover above $50, cocktails push $25, and parking costs rival airport rates, the magic of Vegas feels less like a fantasy and more like a scam. Guests are voting with their wallets, and too many are choosing to stay home. So, can Caesars survive beyond 2025? Yes, but only if it confronts the reality that Vegas must change. Pricing strategies must shift, locals must be valued, and the city must rediscover what once made it irresistible: the feeling that no matter your budget, you belonged here. The fall of Caesars from the S&P 500 isn't just a corporate headline. It's a mirror, reflecting the vulnerabilities of the entire Las Vegas Strip. And if change doesn't come soon, the empire of neon could face a future dimmer than anyone imagined.